If you ask any investing legends like Warren Buffett, Bill Ackman, take your pick, Peter Drucker, what do you think is the number one job of every CEO of any big company in the planet? Is it to manage your company better, increase your profits, lower your costs, fire people? See, these things are important. The most important role of any CEO on the planet when it comes in terms of investors' mind is to increase the return on investments or ROI. Not just profits, but return on total capital invested. Why? Because this is actually how the real wealth is earned in the world. This is actually a wealth hack for short. Let me show you how. Let's say you decided to open a lemonade stand and it requires $3,000 to start one. You have $2,000 and you took $1,000 from your dad to start it. Why your dad? Because it's a lemonade stand. Come on. Who is going to give you money to start a lemonade stand in 2023? Your dad says, okay, pay me 10% interest on the $1,000, that is $100 every year till the time you pay me back. So you start your lemonade stand with two things. $2,000 of your own money and the $1,000 which your dad gave you at 10% interest. So the total money invested in your lemonade business is $3,000. So the total capital invested is equity of $2,000 and debt of $1,000. The total capital invested is $3,000. So let's say you start your lemonade business and you did pretty good. By using that $3,000, you did $9,000 in sale and earned, before paying your dad, after incurring all the expenses and everything, $1,500 of income. Now, out of this $1,500 of income, you paid $100 to your dad. That was the agreement, right? And you were left with $1,400. Now, the government wants a share and the government taxes your income at 20%, resulting in taxes of $280. So, the net profit after tax is $1,122. $1,120. Sales $9,000. Profit before paying interest to dad $1,500. Dad interest $100. Profit before tax $1,400. The taxes is $280. So net profit is $1,120. So let's assume you want to calculate operating profit after tax. That is, if you want to calculate how much you are making on all the capital invested in your business. Remember, your money plus your dad's money. So we take $1,500 earned as operating income. That is profit before paying any interest to your dad. And what you get? You get $1,500 on $3,000. That is, you get 50% return on your capital. But the government will always get its due. The government will always tax it. And let's say the tax rate is 20%, as we have seen before. On $1,400, we had paid $280 tax. That is 20% tax rate. So we will have to pay this 20% tax on $1,500 and we'll be left with $1,200. So that means on all the money put in the business, your money, dad money, you are earning $1,200 on it. That is $1,200 divided by 2,000 dad money, your money plus dad money. That gives you a return on capital employed of 40%. And this is exactly the formula for return on capital employed. That is operating profits after taxes. That is the $1,200 which you were earning. So operating profit before taxes was $1,500. That is the money which your business was earning for you and your dad. $1,500. After taxes, 20% was gone. That is $300. So operating profit after taxes, $1,200 divided by the value of your equity. What is book value? Just forget right now. Just understand the value of your equity. That is $2,000 and the value of your debt. That is $1,000. And we will deduct cash and marketable securities. Now you will be thinking, okay, I understand why operating profit after taxes have been taken and we have divided equity and debt. But why is this cash deducted? So why cash is deducted? Cash is deducted because we are calculating operating income on the capital which is invested in the business or which is being employed in the operations of the business. And this cash is not being employed at the business as an operating asset. Think of your example. If in your lemonade stand, you put a total of $3,000, right? That is 2,000 your money, $1,000 dad money. And you take that, and out of those $3,000, you put $500 in just bank account effectively. So you have put only $2,500 of capital in your business. So to calculate return on capital employed, we basically deduct the cash or the bank balance in your balance sheet. So that is why the cash balance is deducted. Companies with very, very good modes usually have a high return on capital, far exceeding 30%, and companies with good mode have a return on capital exceeding 25%. When you are trying to look for moat of any company, we are looking for a high return on capital in the range of above 25 to 35%.